Welcome back to the Generational Investors Podcast, where we explore the timeless principles of building lasting wealth. I'm your host, John Woodard III. We're back here this week with our featured anchor guest, Mr. John Woodard, founder and president of Woodard Company. Here this week, there's been a lot going on in the markets, but we won't really get too far into that. But this week, we're going to be talking about the Federal Reserve, kind of what it is, and it's timely in the manner that Kevin Warsh has been the elected new Fed Chair as of April 29th, I believe, through the Senate Banking Committee, and that was thanks to Tom Tillis being the swaying vote and kind of just getting a little bit back into that. It's just he
It'd have been a lot easier if he hadn't opposed him from the start.
Yes.
Because anyway,
he's actually a Republican from North Carolina here, but he just when they went under a probe for criminal probe on
spending billions to remake the Fed building.
Yeah, we won't go into that, but once the Justice Department dropped that, Tillis voted his vote.
Get him out of committee.
Yes. So, anyways, there's a lot going on, and actually, just one thing to note that the Iran conflict looks like it's coming to an end. Potentially, more news this morning, and another thing of note is just memory stocks: SanDisk, Micron, Western Digital, Seagate, everything. Those have been just powerhouses you've been seeing, but yet they're still trading at a very low forward PE just because of the shortage and the anyway.
Yeah, and the thing is, the earnings growth on these memory stocks is just exponential. And you say, how can, for example, we bought SanDisk 5 weeks ago, I think for $600 and some dollars a share. They went over $1,400 yesterday, and you say, well, how can that be? That's ridiculous. That's like 1999, 2000, but not necessarily. A lot of those companies that came out in that era, they just put tech in the name of it, in the name of their stock, and people were buying it. They didn't have any earnings. A lot of them didn't have any really product to speak of. These companies have real earnings. They're right now the S&P's price to earnings multiple, and what it is that you take the current trading price of the stock and you divide it by its earnings per share, and you get the PE multiple. And a PE multiple is a good way to kind of look at a company and compare it to other stocks in its group. But also, it's a good way to look at if a company's earnings are growing rapidly, usually it commands a higher price to earnings multiple.
Just at the end of the day, earnings is really what propels a company forward.
Exactly. In U.S. analysis of the markets, absolutely. And so right now, I guess the S&P is 22 times earnings, let's say. Well, these companies we're trading at like 10 times forward earnings, which is half of what the S&P is. So it's just because their earnings growth is just exponential. And I remember back in '92 looking at Cisco. Cisco made routers, and it was trading. I looked at it and said, "Gosh, it's a great looking stock, but it's trading at 40 times earnings." Well, I think a $10,000 investment then grew to $15 million 18 years later. 8 years later. 8 years. So it's just, you can see how we don't know how long this will last. Just like Micron, I think we bought it in the 80s. It's 660 now.
Yeah, I think 675.
And once again, but when the earnings flatten out, when they're no longer have the exponential growth, but if these stocks were trading at S&P multiples, SanDisk, which like I said was $600 a share 5 weeks ago, if it was trading at the S&P multiple right now, it'd be trading close to $2,800 a share. You think about it, it's only 14. So it's just an extraordinary period. And this is one of those. This AI build out thing is just one of those things you want to be a part of during these early stages. And like as we were discussing yesterday, one of the signals that we'll look for when we think we're late in the cycle will be like if you see a lot of IPOs coming out, and like you saw a shoe company,
Allbirds, they were shoes and sandals and everything. They just came out saying that they're going to be AI company. They shot up 700% in a day.
So that's the kind of thing down the road you kind of want to look at and think about. If you see, we expect a lot of IPOs. Got SpaceX coming this year. You got Anthropic, and these are going to be hot. But late in the cycle, when you get companies like a shoe company coming out and say, "Hey, we're AI," and
It's
then you may be in a situation where things are a little overheated.
that makes sense.
Anyway,
So just something to keep in mind, something that's really big right now. So just dive into the topic for this week, the Federal Reserve. Can you just give investors a little bit of a insight to what exactly the Federal Reserve is, what their policies are, why they exist?
It was created in 1913, and they're one of their to stabilize markets, to regulate banks, and they have two mandates: employment and inflation. And they want to keep full employment and moderate inflation. They are unfortunately just Keynesian strictly. They classical economics does not really come into their mindset. So a lot of times, inflation typically is going to come from too much government spending, printing too many dollars, and so you get too much money chasing too few goods.
Definition of inflation.
True. Now you can get there's different types of inflation. You can get demand inflation. You can get where there's inventories are not well managed. But that was really back in the 70s. Now with computers and everything, they can manage inflation. Also, you can get income-driven inflation where salaries are rising too high. I don't think we've seen that in a long time. But when if it could be like a demand pull with salaries increasing. So the Fed right now, this the oil shock from Iran conflict and so forth is likely very temporary and should not cause the Fed to hike. But what have we seen? We've seen three of the members of the Fed want to hike. I think one, Marin, thinks we should cut. I mean, it's just,
a lot of dissents from the consensus, which is very rare.
Which is very rare. In fact, the most dissents we've seen from consensus. This is not government printing money. When the economy is strong and powerful, it's a healthy inflation, and it's not a big inflation. It's just kind of a steady. And you want a little inflation. What you don't want is deflation. That's what that's what Japan had starting in 1988, 89, somewhere in there. They deflated for like 30 years. It was awful. And so, anyway.
And so, talking about cutting rates, hiking rates, and everything, what exactly does that mean, and what kind of impacts does that have on the just broad economy?
Well, to start with, more often than not, the markets should determine what interest rates are. You can get environments of like the Biden inflation, the worst inflation in 40 years. You can get circumstances like that where
it hit 9%, give or take.
Yeah, but then you get things like in 2009 after the crisis. The Fed should stay out of it most of the time. But you get a crisis situation, and then what they decided to do was something called quantitative easing. If you don't mind, I'm going to go into that briefly.
Yes, and that's talking about the Fed's balance sheet.
Right, and so they stated at the time that it was to try to help the economy grow. But for the next 8 years, they started this in 2009, GDP was flat, around 1%. Federal Reserve actually did a study, and they showed that it did not help grow the economy. What I think was very obvious to anybody that would looked at it, that what it was, the Fed increased their balance sheet to $6-7 trillion.
That's what it is.
And what they did was they bought mortgage-backed securities, and by buying them and continually, they slowly pushed interest rates down, and they got mortgage rates to 2.5%. So you think about it, hey, that's great. You can buy a house at 2.5%. Well, that was good for you. But for your children and your grandchildren, not so good, because
people could afford houses that they typically wouldn't be able to.
And housing prices went up exponentially. So now that your children, your grandchildren, like I say, average age of somebody buying a new house is 40 years old. Now, I want to say this too: the reason they went to quantitative easing to push interest rates to zero. And if you remember, CD rates got to like 0.25%. That was your yield. Short-term treasuries were at 0.25%. Like I say, mortgages were 2.5%. The long-term, you're talking about 30-year paper. They didn't do this so much to help the economy, is they did it so they could spend money and not have to pay interest. And when the check came due years later, in other words, when interest rates went up, and now you got $36 trillion in debt, well, it's not their problem. They weren't there. They can't help the fact that now we have 30. Well, they spent all this money, and they could do it if I could spend all your money and I didn't have to pay you any interest.
That's nice.
Life would be good. Yeah. I mean, just keep spending. So that's kind of what happened. It was a government kind of a ripoff. And once again, spent money on every program there was and didn't have to pay interest. Well, the check came due in 2021, 22. When with Biden inflation, when suddenly COVID, you had all this stuff, and they print all this money,
well as stimulus checks coming into the.
And mortgages go from 2.5% to like 8%, just boom, overnight. But the long-term effect is the average homeowner now, first-time homeowner is 40. The average price of a house is $450,000. And if you look at the houses that you can buy for $450,000, you're like, wow.
Not all of them. Yeah.
Yeah, it looked like a $100,000 house a few years ago. Yeah. Well, more than a few, but so anyway, it was a bad policy. It was obvious to us at the time that it was a very bad policy, but obviously we weren't able to do much about it. So,
and just going back to on the Fed raising and cutting interest rates, what exactly that means is, and just dive in here when I am missing something, but they set the federal funds rate, which is what the banks
can borrow from
the government, and from that it means that that comes into the consumer, and that means that mortgage rates and whatnot, and so it kind of dictates what the whole deal is. And I know the 10-year yield is kind of what a lot of mortgage rates are based off of, but typically the 10-year actually trades at about 100 basis points above, at least on a 100-year basis, 1% above the federal funds rate. Right now, it's a little bit compressed on it, but anyways, it just kind of broadens out to the whole economy.
And forever, the Federal Reserve has tried to control. And once again, their mandates are employment, inflation, and so they've tried to affect this with their short-term interest rates. The quantitative easing I was referring to that they started in 2009. Was a brand new tool, never before used, and that affected long-term interest rates because what they were doing is they're going and buying mortgage-backed securities. Well, you're talking about mortgages are 15 and 30 years. Yeah. So what they were doing, they were now playing with the long end of the curve, and once again trying to get interest rates to zero, and they did it. They effectively did that, but it hurt retirees, people living on fixed income who had money in certificates of deposit. An example is, let's say a guy worked hard all his life and all he saved was, I say all, but $100,000. Well, for years, you got 6% on a CD. That meant 6% on a $100,000 CD, you got $500 a month. Well, if your Social Security was $12,000 a year, that was a 50% raise. Well, after quantitative easing got into effect by 2011, their yields, they were making 0.25% on their $100,000.
That's a big change.
It's nothing. Yeah. And so the people that got punished were retirees, and now the people that are getting punished,
first-time home
buyers, and young people, all the young people. But to that effect too, another Fed thing. You go back to the days of Alan Greenspan when Bill Clinton was in power. They were looking. They said, well, we had inflation in the early '80s, and we had this problem that the costs of government transfer programs like Social Security and welfare were going up too fast. They were given like an 11% hike in Social Security. They said, we can't have that. And so they did the Boskin Commission in 95. Well, starting in 1996,
that changes the whole...
Your inflation calculation, was based upon housing prices more than food and energy. Well, if you're retired, chances are... you've paid for your house. Food and energy is the inflation component that matters to you. Well, they flipped that. So now the people on Social Security were the ones again punished. Their cost of living inflation. And the best example I can give you of that was in March of 2008. A lot of people don't know this or remember this, but oil hit $150 a barrel. And I was looking, I was like, my gosh, $150 a barrel. How is it possible that inflation is only 4%? And we looked at the Boskin. It was ex-food and energy. It was the Boskin Commission. And if you were to look, inflation was really at like 12% on the way it would have been calculated in 1980. If it had been calculated the same way, we would have seen 12%. It's only 4%. I mean, so the government and the Fed, they kind of monkey with us, and they're not, and they're not classical. They're Keynesian.
We can get into more about that in another episode. Okay. But just moving on to now, who the new Fed chair is.
Yeah,
Kevin Warsh.
Yeah.
Would you like to give a little bit of a backstory about him? I mean, we know that he, at least for viewers here, just a little bit that he was originally on the Fed board from 2006 to 2011. So he was there during the 2008 financial crisis. So he has a pretty good amount of experience from there. But also, if you want to give just a little bit of backstory to him, and then also we can go into a little bit about his policies and whatnot, what to expect. He
is a game changer kind of guy. His economic background. I mean, he obviously he's Keynesian. He went to college. I went to Stanford. But he's also, I think he's going to be more classical. He's got this 5-pillar framework for reform: stricter lane discipline for the Fed. They're going to stay in their lane. Overhaul the inflation measurement framework, the Boskin Commission. Active balance sheet shrinkage. In other words, that $7 trillion that he's going to try to work that down. That puts us in a very precarious spot. If things hit the fan again, and they got a $7 trillion balance sheet, and this is long-term paper too. So as interest rates rose, if you were to look, the Fed was bankrupt like many times over. They owned long-term paper as interest rates rose. I'll give you a quick example of that. Silicon Valley Bank.
2022.
Yeah, and they must have had a lot of young men like in their early 20s running their portfolio because they had all this money, and Oprah Winfrey had her money in that bank, and a lot of people. It's a very popular bank. Their balance sheet was in 30-year Treasury bonds, and you saw Silicon Valley Bank going out really quick. 30-year Treasuries when during the Biden inflation, when interest rates rose, 30-year Treasuries for that year fell 50% in value. So now if you held them for 30 years, you got your money back. But if you sold them at the end of that year, you lost half of your money.
That's absurd.
Exactly.
For something that should be a safe.
So imagine, you've got a lot of 30-year mortgages. Imagine what this Fed balance sheet looks like. It is a, if they were marked to the market, if they had to, if it mattered, if they could go bankrupt, the Fed would be bankrupt right now. Mm-hmm. So Warsh also meaningful reduction in forward guidance. In other words, they're not going to be quite as active, and a productivity-driven view of neutral interest rate. This is the classical economics part, the non-Keynesian. Once again, a healthy economy is not inflationary. If prices are going up, in a healthy economy, wages are going up. It's all good. What's not good is when the government prints a lot of money, and all of a sudden there's just a incredible increase in the money supply, and and wages are not rising. And that's where inflation comes from. And if you don't believe, go back and look at Paul Volcker in the 1970s and Jimmy Carter and the inflation that came and the guns to butter economy coming out of Vietnam War. Anyway, I get too involved in this stuff. I hope I'm not too deep in the weeds.
No. There's a lot of historicals, and that's kind of what brings about to things that happen today. History doesn't repeat itself, but it typically rhymes. And so whenever you're coming into a new administration or anything new coming on in the markets, just with news, it's good to relate it to historicals because.
And I started in the business in the 70s when Jimmy Carter was president. I started with E.F. Hutton. I've done this for like 48 years. through Volcker, Bernanke, Greenspan, Powell, Yellen. I mean, in fact, I think Arthur Burns may have been leaving right when I was coming in, and imagine, and Volcker was just starting. But it's fascinating. And I'll tell you, a lot of the stuff you just don't see it on the news because the news has its own way to look at things.
Very much so.
A little slanted, but.
And so right now, based off Ed Yardeni and of many other just predictions markets consensuses, there's no price cuts for the rest of the year for the Fed, even with Warsh coming in. And it's not until September or October of next year, which, given all the signs of things, just with inflation at least being like short-term elevated just because of oil pass-through, because it's going to go through everything, jobs numbers are actually looking more resilient than ever. The JOLTS numbers that came out, that's job openings and labor turnovers, that's something that's came out and is being very good. The ADP private payroll and everything. So it looks like there's reasons to why most of the markets are kind of pricing in no rate cuts. But is there anything that you think, like what our opinions are on it, and then also just second half of this year and going forth, what your expectations are?
I'll be surprised if we don't get one rate cut before the election. It's just, I have never seen it in 48 years. I've never seen it. I'll give you an example. In 1980, before the election, when Reagan was running against Carter, and we had inflation through the roof, and interest rates got up to like 14%. Even in that environment where we had massive inflation, Volcker cut rates before the election, and of course after the election, but it was like screwing the top on a pressure cooker. It just blew the top off, and rates went just nuts. And anybody through that period that saw 16% mortgages will remember it very well. So if Volcker can cut interest rates before to try to get Carter reelected in 80, I suspect, I'd be shocked if we don't see a rate cut. And even in midterms, you get a rate cut. Sometimes I guess you don't need it, but historically I've seen rate cuts occur in that environment. So if we don't get it in September this year, I will personally be shocked. But
I would say one other note just for rate cuts as well is just increasing productivity typically means that it's a good environment for rate cuts, just not put in any other factors. And right now we're in an age of productivity like almost nothing else, just with AI booming and everything, and that's a whole different sector.
See, then that reduces your wage. That's disinflationary. It causes inflation to contract when you have productivity growth, because it means you're getting more hours worked for the same amount of pay or whatever. And so productivity is a wonderful productivity gains, and AI's driving this is a wonderful thing for the markets and for the economy. Like I said, FactSet came out the other day and said we're going to see 27%. They believe we're going to see 27% earnings growth for the S&P this year. And while we have seen it in history,
it's typically coming out of a recession.
Exactly.
Something
it's an uncommon event.
Just because everything has been so bogged down, you get things.
And the consensus just a matter of 3 weeks ago was 19%, which is wonderful. Great. And you see the S&P growing. We're already, what are we up now?
7,300.
7,300 on the S&P. I could really see 8,000 or so by the end of the year. We don't know, but
be great.
Yeah.
So that rounds up the segment for this week, talking about the Fed and Kevin Warsh, and coming into our John's Pick of the Week. This week's going along the lines of health and fitness. We're talking about blue light glasses. And that's just, with today's environment, we're looking at screens more than ever. And especially before bed, it's smart to get blue light glasses. And you can look at different ones. I wear some here at work that are more like Amber's glasses, just
because you're computer screens all day.
But there's studies that show wearing blue light glasses before 2 to 3 hours before bed really helps reduce your body, increase your body's melatonin production and whatnot. Because if you're looking at blue lights, blue lights are just like screens. Anything with screens like TV, tablets, smartphones, whatever, it reduces your melatonin production and everything. And so putting on blue light glasses, which...
And if you think about it, for tens of thousands of years, the sun goes down, you build a fire in the fireplace, 5,000 years ago, whatever, and for years and years, because our bodies kind of evolved that way, or not evolved, but developed that way, and that kind of makes sense. And that your melatonin, your body would produce the things to drive you towards sleep.
Yeah, that makes sense. Yeah. And actually, in 16 separate studies using approved blue light glasses, each one showed there's be some sort of measure of improvement in health or in sleep or circadian rhythm or whatnot, from using those blue light glasses compared to not. So, I mean, it's something just to look at. And you can buy a pair off Amazon for $15-$20. I mean, it's something that's easy to do and everything. So, something just keep in mind. It's a small investment, but it builds on over time, and it can be worth it, because sleep at the end of the day is one of the most important factors of
30 your day, 8 or 10 hours or whatever. Yeah.
So anyways, that wraps up this week's podcast. As always, we thank you for listening. And just to round things up as per usual, our motto, always buy quality and diversify. Thank you. The information provided in this podcast is for educational and informational purposes only. It does not constitute investment advice or recommendation to buy or sell securities or an offer or solicitation of advisory services. It does not take into account your individual financial situation, objectives, or needs. Investments involve risk, including the potential loss of principal, and past performance is no guarantee of future results. Woodard & Company Asset Management Group is a registered investment advisor with the SEC. Please consult your financial advisor or tax professional before making any investment decisions.